Atamare. Okay, good morning, everyone. Welcome. Welcome to the first of our webinars for 2026. Thanks for joining us. So the program today is Andrew Hunt's leading, followed by MDC from the equity team, and ending with Ian Bellew. So the normal housekeeping applies. That is that if you need something, if you're from the press and you need something, then please contact Jez. The Q&A function is live as well, which I will curate. I'll put it to the presenters if it's applicable to them. If not, I'll try and answer it myself. Otherwise, we will answer it afterwards. So the backdrop to presenting today is really quite fascinating. We've got the Fed on hold. We've got Japan doing something entirely different that Andrew will probably talk about. JGB yields on the rise, and then we've got record highs in everything from gold and silver to many of the global equity markets. And right now we are in the middle of earnings season, so a couple of big ones announcing overnight. So yeah, we'll probably cover some of that. Andrew, it is over to you, and thanks very much for joining us from a stormy Guernsey, I understand.
Very stormy, somehow seems applicable. What were you saying? Bumpy seas? I think there's a presentation there somewhere. So we go perhaps straight on to page two of the presentation. Um, yeah, that's the one. No, the top chart there. I think I've been sent that by about a dozen clients in the last 2 weeks. It's this supposed correlation between Japanese government bond yields and the gold price. And I think a lot of people are saying, look, Japanese bonds are selling off, gold's going nuts, inflation must be on the way. Central banks, including the RBNZ, are behind the curve. They've got to raise interest rates. And that is one possible explanation. Um, I think that might turn out to be the case in due course, but it isn't at the moment. I think this is actually something of a false alarm, that there's another driving force behind that top chart, that there's somebody selling JGBs and buying gold. And it's a rather large institution. And that's what's causing that rather than actually telling us too much macro. And yet the bottom chart, nobody seems to want to talk about at all anymore. The blue line there is credit growth in the United States, and that's an understated measure. It doesn't include private credit. The red line is the growth in the nominal economy. And just like the mid 80s, the late 90s, the mid 2000s, just before the pandemic, and really since the pandemic, we have a lot more credit growth than we have nominal GDP growth. That the US is creating $3.5 of money and credit for every dollar that its GDP is increasing. And a lot of that extra is essentially finding its way into asset markets, as it generally has done in all of those shaded areas. And certainly at the moment, if we go straight on to slide four, um, we can see where this is coming from. The Federal Reserve is back doing quantitative easing. They haven't called it that. It's sort of hidden in Fed speak about funding and tax seasons and stuff. But essentially, the Fed is now buying round about $40 billion worth of Treasury securities a month. And I think that's likely to accelerate. It's pretty much given a assurance to all of the US banks that you're not going to be caught short. There'll always be funding for you. Um, I've had a conversation with a couple of treasurers now at some of the biggest US banks. Both of them see this as a license to expand their balance sheets. And we have really quite a dramatic acceleration in bank asset growth, and in particular, that lower right-hand chart. Where are the banks growing their balance sheets? Primarily, it is lending to hedge funds. It's lending to the highly levered private credit sector. It's funding the basis trade. It is creating a very powerful funds flow into markets. And I think that's why we have these Teflon coated equity markets at the moment. Doesn't matter what the news is, we find a way to go up. It's simply weight of money. And this will be providing a stimulus to the economy. And also, now that the shutdown is behind us, we've got quite a sharp easing of fiscal policy. Now, that's not clear whether that will continue. Obviously, politics could intervene there. But at the moment, the US, where growth outside the AI sector had actually gone very soggy around Thanksgiving, US is picking up. So the earnings numbers should be all right. And we've got a huge flow of liquidity. Now, moving on to slide five. that does that optimism in markets, I think, is perhaps ignoring the fragility in the US. And really, I'd say the US is a deficit country. It's got three deficits. There's the budget deficit we all talk about. What people are missing, though, is there's a large corporate sector financial deficit. Now, if you were to exclude about a dozen or so of the really cash generative companies and just look at the median company in the US, then we're back to where we were in the late 90s in terms of how much money companies are borrowing to fund their balance sheet growth, to fund the buybacks, what little capital spending and employment they are doing. Um, so you've got two domestic deficits, and at the moment, they're easy to fund. The Fed's doing QE, so that's the budget deficit funded. The corporate sector's got all this credit growth it can access, so they're funded. The deficit that's problematic, though, is the US's external deficit. The US current account deficit is back up over 1% of global GDP, and that's something of a warning level. Whenever it gets up there, you start looking for a weaker dollar, maybe some problems in the treasury market. Um, and I think people are forgetting this. Really, I think, a complacency from this time last year. I think when we did this call a year ago, we were talking about whether Trump would scare off foreign investors, foreign money wouldn't turn up, the US current account deficit wouldn't be covered, the dollar would fall sharply, US bond yields would rise sharply because of an unfunded deficit. And that didn't happen. In fact, last year, the US saw its biggest capital inflows relative to its GDP since the Second World War. We got the exact opposite, and I think everybody's forgotten about that threat as a result of that. But the question we ask ourselves today is whether events in Venezuela, Greenland, NATO, Minnesota, all of this stuff um, is actually finally going to, perhaps if we go back to that previous slide, I think we're on a timer here. If we had a dearth of foreign buying, then treasury yields would rise if politics did finally put off European investors, as you know, there's a few headlines suggesting that could happen. If Asian investors stopped buying treasuries, then you would indeed see some upward pressure on yields. And then to go on to six, it doesn't really matter which valuation. So if you go to slide six, please, Gemma. It doesn't really matter which valuation tool you use, price earnings ratios, the bond yield versus the effective yield on equities or discounted profits. Um, this is an expensive market. If treasuries sell off, the equity market is going to go down, the economy is going to slow down. Private credit, I think, will be tested, particularly since a lot of the private credit players, people like the business development corporations, I mean, some of these guys are 5 or 6 times levered. They rely on using treasury bonds as collateral to get that leverage. Bond yields go up, bond prices go down, they have less collateral, they're limited to how much borrowing they can do, the secondary markets weaken, and I think private credit would struggle in that environment. So it's kind of all to play for. The one thing we've got to get right this year, with respect to the bottom up guys, I don't think is whether Microsoft is going to treat us to another earnings disappointment, but is whether foreign investors are going to finally react to all the news that we're seeing and stop buying US assets. Because if they do stop, then I think this credit boom, this cycle is over. Um, Number of people are subscribing to US assets, but chiefly, and I think the big player in the room is not Japan. Japan used to be in the 1990s, but its place has been taken by China. So we can go to slide seven, please, Gemma. We tend to think of China as exporting deflation, all those cheap goods in the warehouse that held down the consumer price index in the late 90s, 2000s, and 2010s, although not last year, as it turned out. But China also exports inflation. It might be deflation in the goods markets, but that bottom chart is China exporting capital. And that's into property markets in Auckland, in Australia, across the United States. It's into bond markets, which means governments could fund themselves. I think last year, Chinese purchases of French government bonds might have funded as much as half of France's budget deficit. So there was no IMF crisis. The French government remains very large and it continues to impact the economy. So China's this big donor of capital. And it's been that way since 2015. And of course, these flows go through capital markets by definition. They have an effect on asset prices as a result. They've been a very big inflationary force. Inflationary force for property, inflationary for equities, and particularly when you think about the inflationary effect on properties, that then affects the people's living costs, their wage demands. So there's an inflationary bias in the non-traded goods sectors, which of course New Zealand has experienced, and a deflationary impact in the traded goods sectors. Now, the question is, can that be sustained or is that world changing? So we've gone to number 8, please, Gemma. Some of that money goes directly, but increasingly in this geopolitical world, it goes through places like the Cayman Islands, that little chart down the bottom. Quickly on to slide 9. I think we can skip that bit. Is China's model breaking? Well, I think China's household sector is suffering a Japanese-style balance sheet recession. It's not just that property prices are falling, it's probably the 500,000 properties that people have bought that don't exist, that the developers aren't going to provide, and which building them would cost the equivalent of 60% of China's GDP. So the household sector is taking a lot of losses. It therefore wants to save, and if you're saving, you're not spending. Excuse me. And also the way people are saving is changing. It's in gold, it's in precious metals, it's in cash. It's not in bank deposits because they don't trust the banks. So this is the first shock for China. On to slide 10, please, Gemma. The second one is fiscal policy has tightened. China did ease fiscal policy a year ago, got lots of headlines. Now we're seeing local government spending falling. The budget deficit at the central government level is contracting. That means a lot of companies are not getting paid or not getting paid as much. That's another hit to the corporate sector. No consumer spending, or no consumer spending growth, and this fiscal tightening. Then on to slide 11. Yes, China's been exporting, but the prices they receive for those exports haven't been great, particularly things like EVs and chemicals. They've actually had a lot of deflation there, so that's limited the cash flow benefit of the exports. And also, much of China's export growth is coming from poorer countries who probably can't afford this stuff, and I suspect are paying for it with trade credit, which means the companies that are doing the exports, the Chinese companies, aren't actually getting paid in hard cash for this. So you've got this perfect storm for the Chinese corporate sector's cash flow. On to slide 12. You can see that corporate liquidity in China is collapsing, and I don't use that term lightly, and to the point that the Chinese corporate sector now needs to borrow about 14 trillion RMB a year to keep the lights on, to keep its level of output where it is. But the Chinese banks, because they're losing their deposits as people change the way they save, can only lend about 8 or 9 trillion. So you've got this unfunded gap, which is causing the weakness in China, rising unemployment, the lack of capital spending. But also it means that Chinese companies can no longer afford not to remit all of their export receipts. They can't afford to sneak money out of the country. And so the private sector capital outflows from China, that lower right-hand chart, are falling away. So that big outflow from China, particularly over the last few years, that was the private sector, is disappearing, and I think it's going to get even weaker. And you can see the effect of this in the currency markets. The Chinese currency keeps trying to appreciate. They've got this $1.2 trillion US dollar current account surplus, but now there's no capital leaving. They're not recycling that current account surplus back into the rest of the world. And that's, as I say, putting upward pressure on the currency. So on to slide 13. The Chinese authorities don't want a strong currency, particularly when their exporters are desperate for cash. So we're seeing a lot of intervention by the Chinese central bank. We think they did about 150 billion US dollars of foreign exchange intervention in December alone. Now, when you're that big, there's only really half a dozen markets you can act in. Treasuries, Japanese government bonds, UK gilts, French government bonds, maybe Italian bonds, I guess gold. You're really quite limited where you can put that amount of money. And I think it's becoming more limited. Japan obviously mentioned the Taiwan word. There's been a spat between Japan and China. And so we saw the People's Bank of China, I think, buying significantly fewer JGBs, I guess to make a point. So JGB yields almost to the day started to rise, and instead China didn't buy JGBs, it bought gold, and the gold price rose at the same time. Hence that correlation that we're seeing. And I think that is one of the issues that China is now facing. They're having to do so much foreign exchange intervention to recycle their current account surplus that it's getting quite narrow where they can put it. They can sneak it into the US through the Cayman Islands. They can buy gilts as long as Keir Starmer doesn't say anything he shouldn't while he's in Beijing today. Um, France, they're perhaps a little bit iffy about now following Macron's visit, and I guess Japan is really less attractive to them. But this, I think, tells us what the big call this year is. We've seen the Bank of China, we think, move away from JGBs. Japanese yields jump. Japanese government has a funding problem. I think potentially that's a problem for Japanese equities if it continues. That tells us what would happen to the rest of the world if the Chinese central bank pulled back. So, in terms of what do we need to know about this year, I think it's whether China continues to intervene. And in a market sense, that says to me, if the Chinese currency doesn't appreciate wildly, the chances are bond yields will remain tame and this credit boom in equities in the US and over onto slide 14, please, Gemma. Increasingly in Europe as well. Europe has a ridiculously strong balance of payments at the bottom and a new credit cycle. The UK's got shades of this as well. We're starting a new global credit cycle, which I think will lead to a further inflation of asset prices unless the PBOC pulls the plug on recycling China's current account surplus. That is the multi-trillion dollar question, I think. It's not really what's going on in Japan. That's interesting, and I think tells us a lot about the micro dynamics of debt burdens and the like. But it's ultimately, and we've seen this several times in history, it's whether the country with the big surplus recycles or not. If they don't recycle their current account surplus back to us in capital flows, the cost of money will go up, the credit boom will end. If they continue doing it, then I would ignore the valuation models and just, in a sense, close your eyes and keep buying and enjoy the ride. But any sign that China is pulling back, perhaps Sino-US relations deteriorated, or we just saw that appreciation of the currency, that to me would be a pretty big warning sign. Over onto slide 15, please, Gemma. If US bond yields rise, the US current account deficit will close. The US, I think, would go into recession and that would reverberate around the world. It would certainly hit places like New Zealand quite hard, small open economies. Unemployment would rise in the US. I think it would probably double. So there would be an impact on asset markets. I think there'd be an impact on the credit system, particularly private credit. Then all those cash flow negative US companies wouldn't be able to cover their deficits. They'd have to cut employment. They'd have to cut capital spending, even the data centers. Remember, all of these data centers are being funded through special purpose vehicles. They're being funded through private credit. A lot of it arranged through weird and wonderful places, such as Guernsey, where I'm currently sitting, which has somehow supplied $300 billion to the AI boom in funding just in the last couple of years. Not bad for 40,000 people living on a rock. Uh, really, these things have a certain fragility, and it all comes down to those bond markets. Now, longer term, if this boom continues, we will have overheated economies and eventually bonds will sell off in a year or two or three's time. But I think the nearest danger at the moment, or the one we should perhaps be worried about at this point, is really Sino-US relations and what happens to CNY dollar. That certainly would be that's something I'd look at pretty much every day to see what the trend in that is. If you start to see the Chinese currency appreciating, that's telling you they're not recycling their capital. That would be a big warning sign. But if you don't see that, then I think we can probably continue to live in these Teflon markets. If we can go on to slide 17, please, Gemma. Japan, what is the problem with JGBs? Well, for so long, the Japanese government relied on the Japanese banks, either the commercial banks or the central bank, to buy the bonds. Now, Ueda-san, the governor of the Bank of Japan, is worried about not just inflation today, but a longer-term loss of confidence by Japanese savers in the yen as a store of value. So he's determined to give people a higher return on their deposits and to convince them that the central bank is credible and will protect the real value of the currency. So he's doing quantitative tightening, which essentially is that red line there. But then we have a new prime minister who, very old school LDP, very populist, I guess, in that phrase I hate, wants to expand the budget deficit, issue more JGBs, and that's becoming like a crocodile's jaws. Now the chances are that this system goes into sort of suspended animation in the run up to the election. I'm sure something will be done to keep JGB yields roughly where they are. But as soon as we get an easing of fiscal policy, I think JGB yields will tend to rise because Japan, believe it or not, will be looking for foreigners to fund this budget deficit. Last year, Japan received more money into its bond market from foreigners than it acquired bonds in other people's countries. This isn't the Japan of the 1990s. This is a Japan that borrows from abroad. If they've got to keep doing that, they're going to have to compete with US yields, Australian yields, even Kiwi yields. So I don't think it's that Japan is going to force our yields higher. I think we're forcing Japanese yields higher because we're becoming their creditor. Um, what does that mean for Japanese equities? Very trendy at the moment. A lot of US funds into US equity, into Japanese equities, probably more. There's a little bit of domestic money as well. I think that market can probably continue to rally for a while. Probably the second leg up in JGB yields, whenever that occurs, perhaps in a year or so's time, I think will be more worrying for the equity market than the one we've seen. Finally, onto the UK, slide number 18. I talk about central banks going back to quantitative easing and calling it something else. Well, if we look at the top chart there, that's real incomes in the UK. Rachel Reeves, the Chancellor of the Exchequer, is not going to get her domestic recovery, which means the budget deficit is going to be bigger than they anticipate. There's all sorts of worries about who's going to buy those bonds, but the Bank of England has already ridden to the rescue. The Bank of England might be selling gilts, government bonds in the cash markets. It's doing its pretend quantitative tightening, but out the back door, it's just lent 300. I've actually just updated this chart this evening before this call. That is now 300 billion pounds that the UK central bank has lent to banks and other financial institutions so that they could buy gilts. It's not technically quantitative easing, and the central bank isn't buying the bonds, it's giving people money to buy the bonds on its behalf. But I think that's why the UK bond market is behaving relatively well, despite the appalling economic and political news. I think there is, however, a risk for sterling in this, that if the Bank of England buys all the bonds, the foreigners won't be buying them. There'll be no capital inflow into the UK. That leaves sterling vulnerable given the current account deficit. So in terms of currencies, I think a U-turn by the Bank of Japan away from tightening because they need to fund that deficit for a period of time is bad for the yen. The dollar we know is on a downward trajectory, and I think the authorities are pushing that, and they have that credit boom that will encourage that. And the UK, I think, could be a soft currency. So that leaves us looking for hard currencies. The euro has a very strong balance of payments behind it at the moment. I think the Aussie could turn out to be very strong. I guess that drags the Kiwi up with it, but probably not to the same extent. I think the old favourite of the Singapore dollar probably continues to outperform, and also quite optimistic on some of the smaller Asian economies as well, particularly the Korean won. I think that actually is beginning to look quite cheap. Be more cautious about Taiwan, despite the AI boom and the 50% growth in exports. That's an economy that's got a lot of capital flight as people, I think, hedge their bets given the uncertain future. So that's around the world in 24 minutes. I don't know if there are any questions.
Thanks, Andrew. Yeah, there's a couple of questions that have popped, or one that's popped up online and a couple that spring to mind. But also, I was just looking at all the people online and just wanted to welcome so many of our long-time clients and advisors back on this call. So you've obviously hit the right mark, Andrew. That's good. The question from online is, could you just talk a bit about gold and silver? In particular, and I guess it has some logic when you've got the challenges that you've laid out. But what's your view on where they are sitting lifetime highs right now?
Um, can I do the two-handed economist here? I
Of
think in a
course.
couple of years' time, when all these politicians have panicked about a possible slowdown and of inflating the world, and we're back in a stagflationary world, but gold and silver can continue their rally, and I think they've got further to go on a 2 to 3 year view. In the near term, I'm concerned about gold in that there is a fair bit of leverage always in the gold market, and you're very dependent on whether the PBOC decides to intervene in the currency or not. So that it's not a one-way bet. I don't think it's going to be a smooth appreciation. I think for now, gold's probably got a little bit of more momentum. But if you see a strong CNY, treasuries selling off, I don't think it would hurt to take a few profits in gold if you've got them, and then maybe redeploy for that policy reaction. Because if global bond yields go up, the global economy will slow really quite fast. Every central banker on the planet will be cutting rates. I certainly don't think the Reserve Bank of New Zealand is going to do 3 rate hikes this year. I think the market's very aggressive on that. And it could end up cutting rates if we had a sell-off in treasuries tomorrow. I mean, that's it's a very difficult forecast to be precise on because it's so contingent on events. But um, I could see rising bond yields creating a deflation scare that was bad for gold and then a policy reaction that was good for gold. So it would depend whether you wanted to shut your eyes through any correction or try and trade it.
Awesome. Thank you, Andrew. Just one other matter of housekeeping, actually. Just I've got another question coming on carry trade in yen. But just a reminder to everyone online, the summit invites have gone out, so keep an eye out for those in your inbox for March, depending on what part of the country you're in. So the question is, what scale of yen carry unwind would you anticipate? And I guess more specifically, how do those FX rebalancing, how does that spill over into into global equity markets or other risk assets?
I'm actually pretty sanguine about that, in that if we were having this conversation 30 years ago, in the mid 90s, when Japan's current account surplus was the best, it was about 3/4% of global GDP. It was probably half of global savings, and they were funding at least a third of the US current account deficit at that time. I would have been very worried about a sell-off in JGBs and a yen carry trade unwind. And of course, we saw that violently in 1998 when the yen moved 20 yen in a week. I think those days are behind us. Japan's current account surplus is now a lot smaller. Yeah, they're almost an insignificant surplus relative to global GDP. They've certainly been overtaken by China. Are they going to repatriate? We've seen a few high-profile things. Talk about GPIF, the pension system doing it, and a couple of other life companies have muttered something. But what I hear from the life insurance sector is most of them won't, most of them can't. The banks have still been acquiring foreign assets. They've still been supplying the yen carry trade. Um, Very rarely do you get proper repatriations in global finance anyway. You tend to get an interruption of flows, and I don't think Japan's flows are that important. So, having experienced, lived through, and actually slightly profited from the yen carry trade unwind in 98 around LTCM, I don't think this one's going to be that big. I think Japan is much less important than it was. It's difficult to see a lot of repatriation, not least of all because a lot of the assets they have aren't that liquid.
Awesome, thank you. Great question from online. Just one from me. I was just wondering about if we go back to China for a second, and with Keir Starmer being there at the moment, and they're making announcements about making, travel and easier and less oppressive with visas and that sort of thing. Is there something to it in terms of what you were talking about, the need for China to fund that, find someone to fund that deficit, which I think was, I don't know, 4 or 6 trillion, in what you were saying a little bit earlier.
I don't think China will mind if it gets to export more, and maybe you can raise a bit of capital and there's a bit more cooperation. But I think the little argument about the new Chinese embassy in London is probably close to the mark about what is happening. I don't think China is being shy at telling Europeans just how many of their government bonds they own.
Yep.
And you step out of line, you'll feel it in your bond market, I think is probably the message that's coming from Beijing. So behind all the smiles and the handshakes, I think China might be flexing its muscles a little bit here.
Very good. All right, we're pretty much right on time, so thank you very much for joining us, Andrew, and we look forward to seeing you in person during the year in New Zealand. And we'll move over to MDC if you are there. We can hand over the microphone. Morning,
Thanks a
mate.
lot, Ben.
Thanks, Andrew. The floor is
Morning.
yours, Michael.
Thank you very much. Good morning, Stuart and viewers. Andrew Hunt, always a very tough act to follow, but I'll do my best. I hope you've all had a really nice Christmas New Year period, or at least managed to get some mind space and some time away. Today I'm going to talk to the NZ equity market and just try to provide a bit more context to the narrative that performance has been poor, that the New Zealand market, arguably may have its best days behind it. I'm not saying that's not the case, but I just want to propose a couple of angles to look at things that may or may not, you may or may not agree with, but hopefully you find interesting or at least thought-provoking in some regards. I can assure you I'm not sponsored by the New Zealand Stock Exchange. I get no benefit from this. So let's get into it. So when we think about the New Zealand market, first I want to talk about long-term equity market returns. Second of all, a distinctive feature of the New Zealand market being dividends. And finally, recent performance, particularly over the last 18 months. So first on long-term equity market returns. All humans suffer from cognitive biases, myself included, and recency bias is one that comes up a lot. That's natural, right? We remember the last few years much more vividly than we would the decades before. If I take you on a trip down memory lane in history, back to the golden days of the mid-2010s under John Key, Bill English, through to the end of 2017, New Zealand felt like a different place, right? New Zealand was being praised globally. One particular label that stuck with me personally was New Zealand, the rock star economy. I'm not sure why, perhaps because many of us probably dreamed of being rock stars growing up or pop stars. That resonated. New Zealand performance over that decade to 2020 was so strong that I remember as Chief Investment Officer sitting in Tokyo, speaking to the then head of equities, Mr. Stuart Williams, and asking him what the secret sauce was behind equity market success. It really was that good. Those rock star days feel like a lifetime ago, don't they? But they really wasn't. In the 9 calendar years leading into COVID, so 2012 roughly to 2020, the NZ equity market delivered an average return of about 18% per year, significantly outperforming international peers, including the US, Australia, you name it. With the 2019 return the pinnacle, north of 30%. History gives us context. So let's review and remind ourselves about the deepest, broadest, and most dynamic equity market out there, of course, the US. Returns over 50, 100, 150 years, all cluster tightly around 10% nominal return on average. The NZX free flow index is much younger, of course, much less studied empirically. But over roughly the last quarter century, our long-term return sits about 9%, so not a million miles away. And that phenomenon is common across most developed markets. So as we reach 2020 and into the latter parts, and we have a rolling 18% per annum return, what did we really expect to happen from there? Of course, it could have continued, and potentially, if it wasn't for COVID disrupting markets so much, it might have done. But in my personal view, in many respects, a breather was inevitable. Some may even call it healthy. Rock stars tend to die young after all. The second point I'd like to make is just on the distinctive features of the NZ market, and that's the dividends. We all know that New Zealand's a high dividend market and so forth, but I just want to dig into this a little bit more. What makes a total shareholder return over any period? Capital appreciation or depreciation, plus your dividend, your income from your dividend stream. So one thing that really stands out for New Zealand is that dividends have historically accounted for about 2/3 of the NZX 50's total returns, vastly different from nearly any other peer. For example, the S&P 500, less than 1/3 from dividends. The NASDAQ, hardly anything. Nearly all capital return. So in some regards, New Zealand is less about fireworks like the US and tech, but more of a lighthouse, steady, reliable, guiding long-term returns, not chasing the next big tech hit. So the story here is income, the engine quietly keeping the wealth growing. Since COVID, the market has underperformed global peers, no doubt. And that's what instigated a lot of the frustration. On capital growth, it always has, based on history, long-term history, that is. So let's have a look at the dividend, because context matters. COVID disrupted the companies that drive the dividend engine in New Zealand, and the extremely tight financial conditions that followed only served to compound the problem, squeezing cash flows and dividend paying capacity. For example, take Auckland Airport, Sky City, high quality, dependable dividend payers in many respects. During COVID, they suspended dividends, raised emergency equity just to survive, just to keep the lights on. Air New Zealand's another example. Pre-COVID, paying an 8% yield before going to zero, and now paying closer to 4%. As we sit here now, Fletcher Building, once a healthy dividend payer, pays nothing. Ryman pays nothing. Sky City is paying nothing. So we do feel like this is improving and still has room to improve. Looking back though on this period, you could argue that it's more of a reflection of a one in 100 year shock, if you call that COVID, and not necessarily structural weakness or the end of the story with regards to New Zealand. In my view, the story hasn't changed. I believe as balance sheets recover, dividends will return. To be more specific, Ryman will be holding their investor day early next month, so in a matter of days really. And we're anticipating they provide colour on a dividend pathway to a return to dividend paying status. The more that happens, the more New Zealand can revert back to its old posture, its natural profile, with income driving the majority of total returns, providing stability and resilience over the decades ahead. The third point I'd like to make is just on the recent performance. Now, I'm going to contradict myself slightly here, given what I just said about recency bias, but performance of late hasn't actually been bad. It just feels worse. Why? I reflected on that, and I think largely due to the volatility and the US-driven policy uncertainty just contributing to a tumultuous equity market where you don't know whether you're coming or going in some regards. If we inspect the calendar year 2025, we see a 4% return. It's not outstanding, but when you trace the journey, it's easy to see why it's a lot more respectable than it seems. There was a change of president at the end of 2024, and with the help of early year disappointments from large caps, Ryman and Spark, we were heading down in the first quarter. That was before the so-called US Liberation Day, which entailed so many negative surprises and really flipped the market on the head. By that time, we'd reached down double digits. Yet we finished up 4%, implying a 14% rally across the final 2/3 of 2025. It's not bad. Domestically, the RBNZ executed one of the most aggressive tightening cycles on record. 12 consecutive hikes, including some 50s, a 75, and then actually held the rates restrictive at that highest level for over a year. The economy was essentially strangled. The consumer, for want of a better phrase, the consumer kneecapped before a dovish pivot mid-2024 surprised the markets. Now, if I took that 2025 graph and I extended it back to the dovish turn in mid-2024, which was around June, the market's up actually close to 19% over 18 months. Not flashy, but pretty good. The unusual period has meant many of us haven't paused to reflect on what was actually a strong recovery because we're lost in the noise and the headlines and the volatility. But clearly the 18 months were pretty good despite all the noise. If it wasn't for a few large caps struggling to keep up with their junior peers in the market, the return would have actually been a lot better. One last thing to consider is just negative years. We tend to forget how rare negative years are in New Zealand. That's a negative absolute return where you actually lose money. Yeah, we had a decent pullback in 2022, that's for sure. But the last time we had one was all the way back in 2008 in the GFC. Hard to believe, really. And you compare that to Australia and the US, which have had around 5 or 6 negative years in the same period. It seems we get habituated to the regular positive returns, and when they are modest, we feel frustrated naturally. However, potentially, we forget what really hurts in the bones, the big losses. Thankfully, in New Zealand, there have been few and far between. So what does it tell us about the New Zealand market? Number one, perspective matters. Short-term muted performance often feels worse than it is, and recency bias exaggerates this. In my opinion, the long-term story hasn't changed. Over 25 years, the NZ Equities delivered 9% annual returns, and with dividends contributing about 2/3 of that, a structural feature providing stability and income. And I expect this will return. COVID and the recent tightening cycle temporarily disrupted this income engine, but they'll come back. Recent performance has actually been solid when you look through the volatility, and the negative years are rare. So yes, there's periods of noise and disruption, but I'd encourage you just to step back and take a longer view. And the picture is very different. The New Zealand market's a neat little market, steady income, resilience in the face of shocks, and potential for long-term capital growth. It feels less about flash and more about endurance. Perhaps the New Zealand market isn't trying to be the rock star that it was labelled, but instead the little engine that could. quietly building wealth over decades. And for me, that's what counts. Quickly moving on to finish on the markets. Pretty quiet month to date. The performance had been going pretty well, reaching up 1.5%. However, you may be aware of, it was touched on earlier, the hotter than expected CPI that came in. That just took the puff out of the equity market rally for the month. And the return has turned negative into the final days. That being said, it's down just over 1%, and so nothing too extreme. The funds themselves are running pretty well, slightly behind the market, but positioned for the year ahead and the years ahead as opposed to the weeks ahead. And we feel very confident that a tried and tested, reliable investment process will deliver what we need and what our clients need. And with that, I'll pass back to Stu.
Thanks, MDC. I was wondering where you're going with throwing me in there, throwing my name in. So yeah, this is to everyone online. This is live, and we haven't. I wasn't sure where he was going with that, but it worked out well. So hey, thank you very much for the perspective. Also, thanks for keeping us right on time. So you used up all the time. We'll go straight over to Ian, and yeah, the floor is yours, Ian.
Thank you, Stu, and good morning, everyone. I'd like to provide, I guess, an update on how we see the 2026 year ahead for the bond market. So, moving over to the first slide, I'll just start with how interest rates are currently looking in New Zealand. So, the two lines there are, of course, the New Zealand swap curve. So the left-hand side is where the cash rate is. Purple line is where rates are currently in January. The turquoise line is where rates were in October last year. So you see, the cash rate is currently 2.25, and the far end, of course, is swap rates out 20 years in maturity. Of course, swap is that reference curve that credit margins are priced above in New Zealand. So one very obvious point is that from October to November, we've seen quite a meaningful increase in interest rates. So effectively, New Zealand interest rate cycle marked a turning point in November when the Reserve Bank signalled that they're largely finished with rate cuts and moving to a neutral stance. And then over November and December, we saw, I guess, a relatively aggressive rise in rates priced in by the market. So just putting that in context, the 5-year swap rate was around about 3% in October, and currently it's 3.75%. So around a 75 basis point rise in the front of the yield curve. Longer term rates, 10 years and longer, they went up by about 50 basis points. Certainly once the Reserve Bank is confident that the economic recovery is more entrenched, they will have to reduce some of the stimulus. But the market is currently pricing in 50 basis points of rate hikes by year end. Of course, the economic data will guide the way forward, but the market has probably got a little bit ahead of itself in our view at the moment. Another key point, of course, is that the yield curve still remains steeply positive in shape. So now you get even better rewarded for investing longer in maturity, and you'll hear us talk about that we like expressing carry and roll in the portfolio, that is buying bonds that are longer in maturity because you get a higher yield, and then of course they roll down the curve as well. Right here, right now, look, we think there's a lot of good news factored into the curve in terms of potential recovery. There doesn't seem to be any material risk or catalyst for rates to move meaningfully higher or lower. So the bond portfolios remain positioned longer in duration. I'll just move over to the second slide now, please. So here we have credit margins above the swap curve. There's a couple of points I'd like to make here. So you'll see the top three lines. They're essentially local authority credits, bank and general corporates. The bottom dark blue line, of course, is governments. So the strongest driver effectively of credit margins over the last 2 to 3 years has been those demand versus supply dynamics. So if you look out towards the right-hand side of the curve, you'll see that blue line, that credit margins for governments have moved meaningfully higher, and that's been largely a function of the greater supply of government bonds. We have been increasing our government bond holdings on an incremental basis, and that's on a view that we think these margins for government bonds will improve over time, but that's probably a medium-term story. Also, probably a bit of a wild card to throw into the mix, of course, is that we have a general election coming up on the 7th of November, so who's in government will also have a material influence on the supply of government bonds to the market going forward. Of course, over the holiday period, there's usually cash that builds up that can't be reinvested. So when you come back into the new year, there's quite a bit of money looking to be reinvested, both in short and longer maturity assets. You'll see, if you look at the right-hand side of the top 3 curves, you'll see that they've been trending lower. So credit spreads in New Zealand have been tight for some time. We don't see any meaningful reason why this is going to change. There has been a reduction in general issuance to the New Zealand market. Just people borrowing less, and also more New Zealand borrowers have been issuing into the Australian market as well, diversifying their borrowing programs, and also they can, sometimes achieve tighter credit margins through investing there as well. Over time, having high quality credit in the bond portfolios has proven a consistent value add. So we're still positive on credit, but for example, BNZ has been the first issuance to the New Zealand bond market this year. They issued a 5-year senior bank bond. They got that way at the narrow end of the range, which was 70 basis points. So post-COVID, the tightest bank issuance in the 5-year had been the ASB deal that went at 77. But I think most investors put their pragmatism hat on. We're looking at the BNZ deal. We don't know when the next issuance is going to come. As I said, there was that build-up of money to be invested. And also it's probably flattered by the underlying rise in interest rates. So the coupon priced all in at 4.35%, which obviously looks quite attractive relative to retail term deposits, which is somewhere around 3.6 to 3.8%. So the deal was well supported by both wholesale brokers and retail investors. Moving on to the next slide, please. Okay, so on the left here we have a composite of business sentiment. So that combines both the service sector and the manufacturing sector. As you know, agriculture is also quite a large part of the manufacturing sector, so obviously that's been doing well, but the rest of manufacturing has had a fairly hard time of it. If you look at, from, I guess, October onwards, there's been a meaningful uptick in how business view their prospects going forward. Of course, it's quite normal that business confidence front runs actual consumer confidence in a recovery cycle. Something that Reserve Bank will be watching quite closely is the number of businesses that would like to increase their prices. Of course, their ability to increase their prices always depends on the consumer willingness to pay those higher prices. So moving over to the right side, so this bar chart shows annualized consumer spending. So, if you look back at the pink obviously spending was contracting, but then over the last year we've seen, I guess, a moderate recovery in consumer spend. In fact, the last dark purple line was the Black Friday sales. And that's been fairly evident that consumers are probably waiting for opportunities when prices are reduced to go out and spend. And then you see in December actually consumer spending slowed down. But also something I think it's quite important to note is that you see that annualized increase in consumer spending is still running below 3%. So that's below the inflation rate. So there's effectively no real growth in consumer spending at this stage anyway. So turning over to the next slide, please. So here we have the weighted average mortgage rate, which is the green line in the middle. So this is effectively the average mortgage rate that houses are paying at the moment. So you see that's around about 5.2%. And the blue line is the 1-year mortgage special offered by banks, and the purple line is the 2-year mortgage special. So if you look at the right-hand side, obviously the average mortgage rate that households are paying is still higher than the actual rates that are on offer. So over the next 6 months, there's around about 47% of households that will come off fixed rates and move to lower mortgage rates. So that will be some positive stimulus for them. But as we said, underlying interest rates have moved meaningfully higher over the past couple of months of 2025. So you'll see that uptick in the mortgage rates, where most of the major banks have increased, their special rates by around about 30 to 40 basis points. So that is going to reduce the benefit or the stimulatory effect, I guess, when households do actually reset at lower mortgage rates. So moving over to the next slide, please. So just last week we had inflation come out. We've got a new governor of the Reserve Bank, Dr. Brenham, who said she is laser focused on inflation outcomes. We don't know actually what that means yet in terms of policy settings, but of course the Reserve Bank will be out to, I guess, update their view on New Zealand economy and interest rate settings in February the 18th in short order. But essentially, headline inflation came out at 3.1%. So that's the highest it's been in the last 18 months. And also the increase in prices across the basket was probably the most broad-based it's been over the last 3 years, with around about 80% of prices rising. If you look at the actual breakdown, so look at the purple line, that's CPI adjusted for administrative cost. So that's been one of the reasons, I guess, why CPI has been stubborn. Has been those the government costs, insurance rates, etc., have been fairly sticky. Also, those charges effectively reduce the consumer's ability to spend on other things in the economy. So they're a bit of a handbrake to, I guess, economic recovery. And then the green line, of course, is CPI ex food and fuel and energy. Food has been relatively stable, but obviously things still remain expensive on the supermarket shelves. And energy had a bit of an uptick last month as well. And there was a bit of an aberration in that airline prices went up, somewhere around 30%. So we'd expect some improvement in the next CPI outcome. So look, it's not ideal for the Reserve Bank. It doesn't necessarily mean that they have to start reducing stimulus. But yeah, it is problematic. So if you remember back to August, when the Reserve Bank came out and said that, that New Zealand economy had a double dip and they were going to cut interest rates further. One of the main reasons they gave for having confidence in further reducing the cash rate was that there was a lot of spare capacity in the New Zealand economy, which they thought would mean that the inflation rate was going to trend back to the midpoint around 2.5% over the medium term. So they'll be looking for some improvement in the inflation story going forward. And we'll just turn over to next page, please. So that's the conclusion. So I guess essentially our view is, look, we think, carry and roll should remain a value add, important value add for the portfolios going forward. Rates have moved higher. They've probably got a little bit ahead of themselves in terms of positive I guess, aspirations for the recovery in the economy and how quickly people see the Reserve Bank hiking rates. Our thoughts are that rates will most likely be on hold for the majority of this year. Commentators are reasonably split at the moment between expecting the first hike in September or December. Of course, there's an election in the interim, but the Reserve Bank is independent, so that shouldn't necessarily prevent them from hiking around the election date. And that's the update. Thank you.
Thanks very much, Ian. That's great. Good food for thought there, and yeah, really interestingly poised. The one thought I had was that final comment about the Reserve Bank, you know, being independent. I guess there is a history of them not doing much um, around election time. So if there was something to be done, maybe it means they go just a tad earlier. Um, yeah, that's my only sort of. It's a question, I guess.
Yeah, look, that's why some commentators have brought it forward to September because they have a full monetary policy statement then, so they're more able to more fully
Yeah,
explain, why they're hiking. But, look, really, if they do hike, we're only talking about a reduction in stimulus, and we've already seen that through proxy in the market as, moved rates,
yeah,
75 basis points. So we have actually had a tightening without the Reserve Bank actually needing to do anything at this stage. So that should buy them some time as well.
yeah. Good point. Okay, thanks very much. We're pretty much right on time. Thanks everyone for dialing in. Actually, the other thing I was just going to say is if you need any slides from that we've used today, then just zip a request through to the distribution team and we can help you out. Otherwise, stay safe and enjoy hopefully a couple of extended weekends, maybe the days off in between. And we will see you next month. Thank you very much.